Welcome back to the Brent Bruce Daily, where each day we take a look at where home loan interest rates are, where they really are, why they are where they are, why they are moving, and what to expect in the future so that we can better predict what is going to be happening in the housing market in the coming months. And we try to explain why all this is going on and how it works. Today is December the 9th, 2022. It is 3:17 p.m. Central Time. We are about 40 minutes away from the market closing, not only for the day, but for the week. The bond market, which is what we watch because that is what affects home loan interest rates. We've been talking the last couple of days about the three reports or the three events that are going to be happening in the next few days that are really going to possibly affect home loan interest rates. The first is the producer price index that came out today. We're going to talk about that in just a moment. The second is the consumer price index that's coming out on Tuesday. And then the Federal Reserve announcement when they will announce what they're going to be doing with the federal funds rate, which is coming out on Wednesday. So each of these are going to be impactful on home loan interest rates. Let's take a look and see where the producer price index numbers are right now. I can tell you that they came in a little hotter than we wanted them to. Home loan interest rates are up for the day ahead of the weekend, but weekends do play a part, and we're going to talk about that quickly as well. So let's jump over here to the report. Wholesale prices rose 0.3% in November, more than expected, despite hopes that inflation is cooling. This is interesting. Despite hopes that inflation is cooling, we're going to show you why you always need to look further into things in just a moment. So first of all, when you look at either the CPI, which is a consumer price index, or the PPI, which is the producer price index, essentially, this is taking what they consider a basket of goods and pricing those items out. And then next month, they take that same basket of goods and they price it out again. If it costs more, then there is inflation. And that's basically how it works. Now, this basket of goods contains many things: housing, fuel prices, food prices, healthcare. So how do you put that in a basket, right? But that's how they figured this out. They have this huge item or list of static items, the same items that they use each month. And that's how they gauge inflation. Okay, so the producer price index is gauging those items that are in the basket are more raw materials. So for instance, if the consumer price index is measuring the cost of a Snickers bar, the producer price index is measuring the cost of the chocolate that makes that Snickers bar. Okay, so it is the items that are used to create the items that the consumers buy. All right, so hopefully that helps you out there. So in the report here, we always like to look not at what is called the headline number, which is the number that you're usually going to see when you turn your TV on. We like to look at the core number, okay? So the core number is that basket of goods, but it's excluding food and energy. So we take food and energy out, and that gives us the core number because those items are so volatile. Now, that's just, that's what we follow. I don't especially like it because I think food and energy are pretty important, but that's how the core PPI works. So there it is. Core PPI came in at 0.4, and we expected it at 0.2. So it actually came in twice as high as we wanted it to on a month-over-month reading. So that basket of goods for October actually cost 0.4% more in November. That's how they come up with those figures. So the annual number is how much, if you were to go from November of 2021 to November of 2022, how much had that basket of goods increased? Excuse me. So in general, core PPI was up 6.2% from a year ago, compared with 6.6% in October. Now, we've talked before about how that can happen, how you can have month-over-month inflation go up, but still have year-over-year inflation be going down. You have to go back into our previous recordings to be able to see how that works. But here's what I want to show you. So it says right here that November, as food prices surged, dampening hopes that inflation could be headed lower. Okay, so why would you be dampening hopes if you went from 6.6% to 6.2% on inflation? If you went from this peak here down to this item here, so this reduction here, why would that be dampening your hopes? Let's take a look at another chart here, and I'll draw a quick line for you. So This is from the statisticians over at Fred. You can look this up online, but this is showing you producer price indexes in commodities. So here is February of 2022 to March of 2022. Look at the trajectory. All right. Now here is from March to June. Look at the trajectory. So if you were to draw a straight line, which I obviously cannot do, and then now here's from June to November. Look at the trajectory. Okay, so this is rocketing up. This is kind of going up. This is barely going up. So why are they saying that inflation, dampening hopes that inflation is subsiding? It clearly is. You see the charts doing this. You see the inflation going from a rocket ship to leveling down a little bit more to beginning to level off. Now, we don't think it's going to start going down. We don't want to see deflationary pressures, but this shows that inflation is subsiding. This is something that we've been talking about, and it's so funny to watch the media act like inflation is not subsiding when any chart that you take a look at shows, if you draw these lines, it is subsiding, which is why we're so confident that home loan interest rates are going to continue to come down into 2023. So where are we right now on our home loan interest rates? Let's take a look. Yesterday, we were celebrating another 5.99% with 0 points on our 30-year fixed Brent Bruce daily interest rates. Well, here we are. Now, unfortunately, you guys know this. You guys have been around long enough. No, this is not good. Why? In your head, I hope you're saying because we are now broken through the floor of support, which was the 100-day moving average. I wish we were in a room so I could have everyone say it at one time. We broke through the floor of support, which is the 100-day moving average, and now we are below it. And unfortunately, if we stay under it for a couple of days, it will become a ceiling of resistance and keeping us pushed down. Now, here's what I want to make sure you understand. Look at the 10-year Treasury, also up 9, not what we want to see, but that's all right. So understand that today is Friday. People, the bankers of the world, the investors of the world, they see Friday come and they go, well, it's Friday, didn't have the greatest producer price index numbers, worried about the consumer price index coming out on Tuesday. Who knows what's going to happen with the comments that come out from the Federal Reserve on Wednesday? I'm going to start taking some chips off the table. And that's essentially what they do. They start to take some of their investments off the table, put them on the shelf, and wait to see what's going to come out on Monday, Tuesday, and Wednesday, because that's really going to show the next moves that the bond market is going to take. So where are we on our interest rates? So let's take a quick look. Where'd it go? Open this up again. Okay, here. Remember that we were at 5.99% with 0 points yesterday. We were happy that we were still there. So let's pull up the scenario for the Brent Bruce Daily, which again is our very well qualified 30-year fixed conventional home loan, 25% down, 800 FICO score, single family residence, perfect client. Look at this, 6.375. That is a pretty big jump in one day. Why is that? Again, it's Friday. They're taking some chips off the table. They don't know what's going to happen over the weekend. What if something geopolitically happens? They tend to put a little bit of an increase in the interest rates on a Friday ahead of what's going to happen over the weekend and ahead of how the markets open on Monday. Now, they may open on Monday and have interest rates back at 5.99. But over the weekend, they're going to be a little bit careful and keep it at 6.375 because they can't manage the bond market over the weekend because it's closed. But let's open this up. We always take a closer look. 5.99. Man, I wish we could get that. Oh, we can. It's $965. So for only $965, you're still at 5.99, just about a quarter of a point. And as we know right now, we're probably going to ask our sellers to cover that anyway. And if they give us a little bit more, we start moving further down the chain here on our 5%. Okay. So we are still in a great position here. Let's go over and look at our breakdown of what makes up our Brent Bruce Daily for compliance purposes. That's what we have going on. I appreciate the comments I've been getting recently from many people, just that they like what they're hearing here. Let me know if you have any comments, thoughts, suggestions, questions, what you would like for me to get further into. And of course, understand that I get paid by doing home loans. I am a mortgage broker. So if you have someone that I might want to talk to, about doing a home loan for them, pre-qualifying them, or getting them into a home with the interest rates that you're looking at, please reach out to me. My information is always in the comments below. Go ahead and go to the Beacons link that is in there. My information is right there. Or if you just want to talk, maybe give me your thoughts. Let me know. I want to hear what you have to say. Have a great weekend. I will get back to you, and we're going to talk about the CPI and the Fed meeting on Monday. I know you're excited. We'll talk to you soon.